Whether a rate hike comes later this week, later this year, or even into next, it is coming, and there will be more after that. But the pace of the interest rate hikes is expected to be gradual, and the size of each rate hike expected to be small. So while the impact on your money may be limited in the short term, the same can't be said for the long-term effect. According to the most recent CNBC Fed survey, economists see the rate hike cycle ending in about 3 years, in the third quarter of 2018. With the Fed funds rate reaching 2.79%. The current Fed funds rate target rate is near zero. And there are steps you may want to consider taking right now to prepare for higher borrowing costs down the road. If the full thrust of the rate hike debate has you wondering what to do with your investments, you're probably not alone. Yes, a changing interest rate environment can cause violent swings in the stock market. Those ups and downs, though, as dramatic as they may be, are a good reason to keep an eye on your asset mix. Rather than worrying about where the stock market will be next week or next month, stay focused on your longer-term investment goals. With rates near zero, a quarter-point rise won't likely have a major impact on your day-to-day life. The interest your bank is paying on a savings account still won't make you smile. But if rates continue to rise, say 7 or 8 times in 3 or 4 years, you will begin to notice. When it comes to the cash portion of your investment portfolio, as rates begin to climb, consider laddering or overlapping the expiration dates on CDs. Laddering allows you to step up to a higher rate each time a CD expires. As for bonds, short-term bonds and bond funds may be safer if the Fed is raising its lending rates. Expect bond yields to climb, which means prices will drop. If you're in a longer-term bond or bond fund with mostly 10-year or 30-year bonds, you'll have to stand by as the value of that bond drops. If you're in shorter-term bonds, you'll limit the time your investment is exposed to a falling bond price, while also getting the benefit of a rising yield. Retirement savers, look under the hood. Bond funds are a big part of target date funds in many 401k plans. As you get older, your plan tends to put more of your assets into fixed income, so check on what type of bond funds are in your plan. Mortgages will also be impacted by rising rates, so if you're determined to get the lowest possible rate, think about taking action before the Fed, but don't worry. 30-year mortgage rates have been hovering at or below 4% on average this September. Rates were double that 15 years ago. And that's a level we're not likely to see anytime soon.